Welcome everybody to the Planet MicroCap Showcase Virtual. I'm your host, Robert Kraft, on behalf of SNN Network, and thank you all for joining us today. I'd like to introduce our next panel here at our event. It is the SPAC to De-SPAC panel, and is being hosted by Jaime, Krug from Centri. We'd like to thank Centri and Marcum as sponsors for our event. And with that, Jaime, take it away.
Thank you. And good afternoon. Thank you all for joining us for today's panel. As mentioned, we'll be discussing the SPAC and De-SPAC process. We've assembled a panel of experts in the SPAC industry as it pertains to legal, accounting, and auditing matters, who will be going into detail about the popularity of these transactions, some of the compliance requirements, and of course, current events. First up, we have Christopher Mora. Chris is a partner with Centri Business Consulting, where he oversees the firm's SEC and capital markets practice. Chris regularly advises clients on the accounting treatment of various transactions, including complex debt and equity, business combinations, reverse mergers, and various SEC-related issues. While Chris works with clients in a variety of industries, he has a specific focus on SPAC transactions and clients operating within the digital asset space. Next up, we have Natalie Verbanac. Natalie is an audit partner at Marcum LLP in the firm's New York City office. She has more than 20 years of experience working with both public and private companies in the areas of accounting, auditing, due diligence, and capital financing transactions. Natalie's industry focus includes SPACs, IPOs, life science, technology, and food and beverage clients. And finally, we have Barry Grossman. Barry is a partner and founding member at Ellenoff, Grossman, and Schole. Barry's practice focuses on representing public and private companies, companies with locations both foreign and domestic, and those raising money in the United States or participating in mergers or acquisitions, as well as general corporate matters. His clients include SPACs, biotech companies, software developers, and FINRA registered broker-dealers, just to name a few. Moderating will be myself. I'm Jaime Krug, partner at Centri Business Consulting, and I oversee the firm's technical accounting practice. So without further ado, let's go ahead and jump right in. To say that the market is seeing a heavy influx of SPAC transactions would probably be an understatement at best. 2021, we're already seeing 308 SPAC IPOs as compared to 248 in all of 2020. So Barry, I'd love to bring my first question to you. SPACs are far from being a new vehicle for companies to utilize in going public. So why all of a sudden are they suddenly considered to be such an attractive option in comparison to a traditional IPO?
Well, Jaime, life has certainly changed with SPACs. Right now, we are in what people refer to as Generation 3 SPACs. And, the history we could talk about for the next 2 hours, but let's just say where we are today. SPACs have become, let's call it the prettiest girl on the block. Everyone wants a data SPAC. I mean, I literally spend half my day, or 3/4 of my day, on the phone call with private companies that want to merge with the SPAC. And all the SPAC is really is an alternative to an IPO. I mean, that's all we're really talking about. What you're doing, though, is you're betting on the jockey. You're really betting that the SPAC team can go out and find a good deal. Okay, and that's not dissimilar to what an IPO is, but you're starting from a different place. So you're basically engaging with highly successful individuals. It used to be in Generation 1, Generation 2, most of the SPAC sponsors were operators. In this generation, about 45–50% of the SPAC sponsors are either private equity guys, VC guys, or investment banks. And if you include people that are on the second or third or fourth SPAC, that's probably 60–70% of the market. But as we said before, a SPAC is really just another way of taking a company public. It's got certain built-in advantages over an IPO. The biggest advantage is that you can use forward-looking projections when you decide or when you market the SPAC, where you cannot do that with an IPO. Having said that, the SEC has very recently, within the last few weeks, come down and said, well, wait a second, guys. We really do think this is like an IPO, so maybe you shouldn't be using forward-looking projections. And that's really about to change, that you will not be able to do that or use forward-looking projections. The use of forward-looking projections has enabled private companies, early-stage companies, to be able to say in 2024, 2025, my revenues are going to be X billion dollars, even though they're basically nothing today. And that's been a huge, huge, huge benefit, to these private companies, and it's impacted valuations. As I said, that is most likely going to go away. And when that goes away, the valuation of some of these companies will certainly change. As you also pointed out, SPACs have grown enormously. In 2019, we basically doubled the record for SPACs. There were 62 SPACs. Last year went to 224, I think it was approximately. And then, as you noted, you're up to about 300 this year. So I believe what's going to happen with the change in the forward-looking projections and some other changes, it's going to impact the valuation on the back end, but it won't necessarily impact, that people wanting to do SPACs. I think you'll still find people out there. People love the structures. Sponsors love the structures. The basic sponsor is putting in 3, 4, 5% of the equity of the deal and getting 20% of the equity when the IPO closes. And that's the basic story. And as we said, the investment banks have fallen in love with this product. They like the fact that they have someone else is out there looking for deals. There's less liability to investment banks, although that might change also if they really do decide to treat it as an IPO. We've, in the last week or two, received comment letters from the SEC with comments that are akin to an IPO type comments, whereas in the past, they were treating it more as an M&A transaction. So life in SPAC land has changed. It is constantly changing, I guess. But in the last year and a half, it's certainly been the most popular target out there. And many, many popular deals and well-funded deals have gotten done.
Thank you. That's very helpful. And sticking with you for just another minute here, as far as the S1 process goes to be filed, could you elaborate a little bit on that process and what companies need to look out for as they move forward in that area?
Sure. So SPACs really have, and about this panel, is 3 stages of life, let's say. The first stage is when the SPAC goes public, when you file either an S1 for domestic or an F1 for a foreign filer. Then there are NASDAQ or NYSE listed company, you're a 34-hour company, you have to file Qs and Ks. And after that, you're doing your business combination. But as far as the S1 is concerned, that's probably, the easiest part of the process. The S1, for an operating company that focuses on the industry and focuses on the management, focuses on history, focuses on everything the company's done. But for a SPAC, it's very different. For a SPAC, all you're really doing is focusing on the management company or the managers or the sponsors of the SPAC. Although the documents, still 80, 90, 100 pages long, a good portion of that, let's call it, 60 to 75%, and a lawyer should never say this out loud, is really cookie cutter. You're really doing very similar to what you've done in the past. Chris, don't smile at that. It's all new and all original. Everything we draft from scratch, you know that. But the way it works is really you're putting in information about the sponsor team and about the industry, and that's really the key. Natalie will talk to you about how an audit is done, and that's certainly an important part of the process. But the S1 itself is really just about the management team and what they want to do. An issue that always comes up with an S1 is, are you going to file publicly? You're going to file confidentially. Up until a year and a half ago, you would never ever file publicly. Now you see more and more investment banks want you to file confidentially because they want to move quickly. They want to get things done. They want to be able to get out to the market as quickly as possible. When there's so many other SPACs out there, you try to differentiate yourself, so you want to be first online. There are some problems with filing confidentially. When you file, if you don't file confidentially, people know what you're doing. The word is out there, so people can see who your management team is. They can see who your directors are. They can see your business segment. Whereas if you file confidentially, you can kind of change it as you go along. You can make changes to your management team. You can make changes to your business focus. And also you can see how the market's going. Right now, if you file publicly, you might not be very happy because right now the market is in effect shut down for issues we're going to go into later. But if you file confidentially now, no one knows you're out there, so no one thinks that you're getting old and cold at this point. The SEC once again has recently said that they will not accept confidential filings unless you have an underwriter on the cover. Once again, they're saying this is akin to a public offering. This is a big change from what the SEC was doing in the past. Previously, you could always file and leave certain material terms out. But those are really your choices. But you're filing an S1 just like in any other public offering.
Thank you, Barry. I think that provides a really nice landscape that'll kind of set the mood for the rest of our discussion here. So shifting the discussion slightly to the accounting side of the house, Natalie, I'm sure there's a number of things to consider as companies are preparing for their audit in connection with a transaction like this. Would you mind spending a minute touching upon what those requirements are?
Sure. So as Barry mentioned, the S1 starts off with, the working with the legal teams and the deal terms and getting the management information within the S1. But an important part of the S1 is the financial statements, where the auditors need to be coordinated with management, the attorneys, the bankers, and in addition, financial advisors such as Centri. This is going to be a Pcrb audit like any other public filing audit. So there are the same requirements as an operating company as there is for a SPAC audit. There are independence issues that, auditors are not allowed to do certain things, which include assisting, preparing the financial statements. We have to do the audit. This is where the step comes in before us, is when Centri, and I'll hand it over after I finish to Chris, on where they work with management and the attorneys on getting the financial statements ready for us in order to perform the audit. There has to be an audited balance sheet. The footnotes have to be audited. If this is a filing that is going to be public, there will be an auditor consent that's required. And we are usually the last individuals or part of the working group list that reviews the document, audits the financials, and we're the last ones to sign off. Chris, I guess any words on your end on how you assist with the companies before it comes out?
Yeah, absolutely. And I think you kind of hit it there. Coordination amongst all parties is really one of the most important things, I think, when it comes to any public filing. I think in SPACs, what's a little bit different is kind of the speed that everything goes through. Majority of us and everyone has been used to, IPOs that take a little bit longer in time as opposed to a SPAC IPO that happens relatively quickly. So the legal team, the financial consultants, the management teams, the auditors, the bankers are all doing a filing very, very quickly that comes together. Now, with that, to Natalie's point, these are still financial statements that are going into a public filing, and these are still PCAOB audits. So here at Centri, we're working with the management teams to pull together the financial statements, the books and records, all of the appropriate support that goes into the filing. Barry had mentioned that it's usually a management team, or it's a VC firm or a private equity firm or things of that nature that are sponsoring the SPAC vehicle. And they might not have the resources or some of the expertise or the nuts and bolts to pull together financial statements or technical accounting, going concerns analysis, EPS, and all of those things that kind of go into these particular filings. So we really, really sit in that function. The other thing that happens, and just on coordination, is often just making sure all of the parties are in working order. There's a cadence that goes along to these filings and timeline that goes along to the filings. Natalie can't start her job until I give her information to audit. Sometimes we can't pull together the financial statements until we get the legal docs from Barry and his team, right? So there's a certain kind of dance that goes along inside of these filings to make sure everyone's kind of coordinated to get something on the door and on file.
Thank you both. I think it's really helpful to get a sense of all the parties that are involved and how they work together. And you both touched briefly on the importance of that coordination, specifically as it relates to hitting some tight timelines. Natalie, I put it back to you. Would you mind expanding upon that briefly, and specifically, what are the timelines involved here as SPACs move towards pricing and ultimately closing?
Sure. So once the audit's completed, that's the first step on getting the S1 on file once everyone signs off on it. And then you have the 30-day wait period with the SEC to comments. At that time, when it does come back with the comments, between then and the closing of the IPO is fast-paced. Depending on if there's any deal changes or structure changes, and if you have any amendments in between. But once a document is going to go effective, the last filing, between the effective date and the closing date you have 2 days, and then you have the 4 days to close and audit, to audit the closing balance sheet. So you're talking about a 1 week's or less than 1 week time from that point. And that's the key of this process of making sure everyone is coordinating, because it does have to go in a sequential order, but there are still the requirements that needs to be done. During that timing, during pricing going effective, us auditors have to provide comfort letters and participate on due diligence calls with the Underwriters Council, including on the effective date and also on the closing date. So that's key to make sure everyone's coordinated and that we're all, on a working group list. Management needs to be involved, even though they do hire, the Centris, the financial advisors. They are the ones signing off on the document, so they do have to be able to participate and be involved in the process and take responsibility for the document. And then during that time, once you close, is the 4 business days of filing the audited balance sheet, which again is another audit during this process for the closing of the IPO. And this one is very, very tight time frame because you cannot miss that 4 business day. And this is where you have to be well coordinated in advance with the financial advisors in order to close those books, get the audit package together, and then have the auditors perform their audit and provide their audit report on the date of filing. So I'll turn it over to Chris to provide any comments during that time period, because he's well aware, as I am, coordination between us is key.
Yeah, it's a very fast-paced timeline. Deal terms change often, right? So deals upsize, downsize, they go from 1/2 warrant to 1/3, kind of anything really to get the deal done and priced and filed. Each time that happens, it has a broader ripple effect into all of the documentation that gets pulled together. And that's really documentation that has to go into the amended S1A filings, the prospectus, and then the AK audit that has to get done, or the balance sheet audit that has to get done and filed on Form 8K right after pricing. So making sure that everyone is on the same page and knows what's occurring is probably half of the battle. I think sometimes you end up finding out that deal terms are changing, an hour or 2 before things are supposed to occur or be filed, which does lead to a little bit more kind of added pressure to pull all of that information together. But what I say, it's a fairly kind of up until this point a fairly well-oiled machine that kind of goes through of knowing what's inside of the document, what's going to be affected if deal terms are going to change and things of that nature.
And if I could just add to that, I think what Chris and Natalie is saying is very, very accurate. The initial filing is almost the easiest part of the process. Once the underwriter goes out there and comes back and says, listen, guys, I can't sell this at a 1/3 of a warrant. I need to make it a 1/2 a warrant, or we're going to upsize, or we're going to downsize. That's really when, Natalie's team and Chris's team really have to scramble to get things done at a very quick pace. Especially in the last year or so, there's so many deals that have upsized at the last minute and that have caused massive amount of confusion, or massive amount of work, I say, rather confusion, because it's a timing issue. Because if you don't get the AK file within an appropriate time, the 4 days, you have much bigger issues. So it's the deals do change; they change rapidly at the last minute, and everyone's really got to be on board and work.
Got it. Well, thank you all for those insights. We've covered a good bit of ground here already, getting to the phase in the process where the SPAC, now effectively is a public company. With that, Chris, I guess as they are a public company, what are those ongoing filing requirements for these entities, and how do you and your team assist with them through that part of the process?
Yeah, I think one of the kind of funny things is a majority of the people that work on SPACs have other day jobs as well too, right? These are, they sit on multiple boards, or they have other funds and things of that nature. So management teams and they're out searching for a deal, right? So they're kind of going through and doing diligence and kind of looking to actually de-SPAC. But these vehicles and SPACs are like any other public companies. They're required to file annual reports on Form 10K and quarterly reports on Form 10Q with the SEC on an ongoing basis. And if anything changes or they kind of have current developments and or issue a new instrument, do some sort of bridge financing or some sort of material event, they have to file a case. And they have to do that within a certain time, 45 days on a Q and 90 days on a 10K. So making sure that everything is being kept up with and kind of coordination with our team, as we're the ones that are kind of helping prepare the books and records and help doing the 10K and the 10Q filings and putting together the documents. It's making sure that, expenses are being kept up with, current events are being kept up with, contracts that are being signed or cataloged and things of that nature. And then making sure that not only, Natalie's very busy, Barry's very busy, all the firms are very, very busy, that there's a filing deadline. So we're not waiting to the end of the 45 days to file a 10K or a 10Q. So it's making sure that the company, upholds and is a public company. Internal controls are a thing to consider there as well too, right? Who's got custody over the bank account and who's kind of watching and signing over particular things and making sure that there's some sort of segregation of duties. And these companies are fairly small management teams and things of that nature. So, at the end of the day, the SPAC is a public company and has the requirements that have to be adhered to for the life of its vehicle.
Yeah, and what I would add to that is, because it's a public company, the filing dates, the filing, requirements are just like any other public company, as Chris said. If you miss any of those dates, you have a big issue. With a recent change that happened in the world in the world of warrants, which Natalie's going to discuss in great detail later, it's really has caused problems for many of these public companies, many of these SPACs, to file on a timely basis. And so it's interesting. We're going to wait and see what happens with either NASDAQ or NYSE, but potentially some of these SPACs may end up being delisted, which would really cause a crisis for them. But we'll have to wait and see. But they are a public company and they have to meet all the filing requirements.
Thank you both. You mentioned, Chris, briefly that, as a registered public company, the SPAC is now on the clock to identify a target company to acquire. Barry, I'd love to hear from you. As far as that goes, could you spend a few minutes covering what that process typically looks like and specifically how they move from, letter of intent ultimately to a merger agreement?
Yeah, and this is really the what you're paying your money for. This is really why the SPAC team gets their 20%, because they're being brought in to find a target. There used to be some investors that came in really just to play the arbitrage, just to get, the return on the cash held in trust, or maybe just to hold on to the warrants. But with interest rates where they are now, that's really no longer the case. So it's really changed dramatically. But the investors are coming in and hoping that the management team can find a target. And what we tell our management teams is that they should be out there starting the first day after the IPO closes, and that they should be looking far and wide for a deal within their sector. And it's a pretty long process, actually. You'll find that they'll sign, an average SPAC will sign 30 or 40 different NDA agreements. And the NDA agreements are a little different than a typical NDA, the most important provision being the waiver against the trust, because you want to make sure that none of the people you sign any agreement with can ever go after the trust. That's sacrosanct for any deal. And the NDA really allows the SPAC to go in there and look under the covers and find out everything about the target company, or as much as they can, as quickly as they can. After they've gotten comfortable, the next step is really signing a letter of intent. And unlike a typical letter of intent, which is normally 4 or 5 pages, 6 pages maybe, the letter of intent for a SPAC is much, much more extensive, because a SPAC doesn't have a lot of time. SPAC's life for 12, 15, 18, 24 months. They need to get a deal done quickly. So they can't be in a position where they're negotiating a deal later on in the process. They want to make sure they have the basic business terms agreed to. And so what I mean by that is they'll talk about how much cash has to stay in the deal. They'll talk about who the management's going to look like afterwards. They're going to talk about the board. They're going to talk about many, many issues that you would not normally see in a letter of intent, which is normally just a generic position. Big issues in the letter of intent also include exclusivity. is the SPAC allowed to keep looking at other deals? A SPAC has one mission. A SPAC is supposed to find a business combination, but the SPAC wants to lock up the target, and so the target isn't looking at other deals while they're looking at, while the SPAC is looking at them. So that's always a big issue. Another big issue is, what type of financing do you need to close the deal? I mean, if you have a $100 million SPAC, that SPAC at a minimum is looking to close a $250, $300 million enterprise value transaction. And, normally they're going to look for a deal even larger than that. Probably 60 to 70% of the SPACs in the last year or so have had concurrent pipes with the closing of their business combination. And some of these pipes are actually larger than the SPAC itself. So when you're negotiating with the target, and the target says we need X million dollars, X $100 million at the closing, at the same time, you need to go out to the pipe investors and seeing if they're interested in the deal. And that's really, also gives you the validation of what the target's worth. Because, if you have a pipe that comes in and says this deal's worth $1 billion and you're negotiating at $1 billion for price, you have a big issue. But the process itself is a long process between, getting the NDA, the letter of intent, and then the merger agreement, which is a very, very extensive document, which eventually is filed with the SEC in one form or another. It's a 3 to 6, 9 month process. So it's a long process.
Thank you, Barry. You mentioned a few things there that certainly catch my attention from an accounting perspective. While, a lot of times it's fairly obvious which entity is identifying from an accounting perspective who the acquirer is in a business combination. Certainly understand that that isn't always very cut and dry when it comes to SPAC transactions. Chris, I'll look at you for this one. As you're doing this analysis for your clients, what are you seeing by way of considerations at arriving to that conclusion?
Yeah, I think, generally right around LOI being signed, we're starting to outline identification of the accounting acquirer, because that's going to really dictate what the S4 and proxy statement and future filings are going to look like for the combined company. So really, when we talk about identifying the accounting acquirer, the SPAC, and Barry can obviously check me on this one, but the SPAC is legally acquiring the target company, though that may not be the case for accounting purposes. When a SPAC acquires a business for all cash, the SPAC is usually the accounting acquirer. But that's not always the case, because deals are often a mix of various different components: equity, cash, sometimes other financial instruments. And there's additional evaluation pursuant to the VIE or voting interest model that has to be considered. Usually we get out of the VIE model and we're into the voting interest model for accounting purposes. And we usually start to look at a couple of different things. We look at relative voting rights is the first place that we usually start. As an entity, what group owns the largest portion of the entity. All right. Sometimes that's not always clear. Sometimes you're in a 48, 52% scenario, or kind of in those 5% of 50%. So it doesn't really tilt or point to one. We look at the existence and the size of a single minority voting interest in the combined entity. Sometimes the pipe investors are those that are either with the target company or the SPAC entity, and that could determine where the equity interests lie. We start looking at the governing body. Okay, so who is going to be a part of the board of directors and who's allowed to, appoint those seats and things of that nature. We look at composition of management. Is the management team of the SPAC going to go into be the management team of the target, or are they kind of just moving on to a certain extent? Relative size of the combining entities and the terms of the exchange of the equity interest. Once that analysis is done, we're able to identify, are we in a reverse merger, reverse recap kind of situation, or are we in a successor or predecessor situation? I think a majority of them are going to be on the reverse merger side, but you do see successor and predecessor deals that are out there that puts a little bit more stress and time on pro forma and continuing reporting requirements for the entity based on information that has to be presented in the financial statements. Sometimes the accounting doesn't dictate how the deal is supposed to go. It's usually the other way around. So we kind of wait and see what the deal is being struck and kind of look at it. Sometimes when we see the LOI, though, some of the value that I think we do add is saying, hey, you're teetering just a little bit here onto the successor predecessor scenario. If you tweak one of these, a board seat kind of here or there, or swing a percentage point, it makes it an easier accounting topic. And we do get in those conversations a good bit.
Thank you, Chris. Definitely sounds like a lot to consider. Each transaction probably has some certain nuances to it that can quickly change your answer as far as who's acquiring who. Natalie, I'll come to you here. Once we've sorted out who that ultimate accounting acquirer is, obviously that would then drive the financial statement requirements for either the proxy or the registration statement. Would you mind covering what companies should expect here as it pertains to those audit requirements?
Sure. So during this process is the most complex part of the SPAC life. As Barry mentioned, this is the third life of the SPAC, or the third stage of the life of the SPAC, the de-SPACing process. And whether it's a registration statement or proxy, more or less the contents of the document is the same. There's a significant amount of the forepart of the document with the management team information, the deal structure, the terms of the merger agreement, a significant amount of information on the MD&A of both the companies. I mean, obviously the focus is on the target company. Then most, a quarter to, about 30 or so % of the document, it is the financial statements, the historicals, and the pro forma, which is really critical to have within, you can't file it without with the information. And the coordination comes again with this because multiple parties involved. The SPAC itself has, as Chris mentioned, been continuously filing under the 34 Act requirements on their due dates or before their due dates, the Qs and Ks. So the concern is really not of the SPAC's financial statements. Those are already done. It's the timing of the target's financial statements. And that's who, during this process, where there's usually the wait because these companies have been private companies and have not been audited for the most part as under Pcrb audits. So there's a lot of nuances when a management team goes out to do their due diligence. And one of their key items in the due diligence process, what I always tell them is to be high in the list, is to find out where they are with the audit. Have they ever been audited before? If have been audited before, can they upgrade to a Pcrb auditor? Meaning if first their audit firm has to be a Pcrb registered firm, and two, for the most part, they have to make sure that they're in compliance, that they did not trip up any independence rules in order to sign off as a Pcrb auditor. And I won't go into the details on that, but after that is determined, then you have the target's audited financials ready to go. You have to determine which ones go into the S4, and it's all about the timing. Generally, you need 2 years audited and an interim stub period, assuming that the last audited financial statements are not greater than 134 days. So for example, a company can go out with 2 audited years and their 9-month numbers through about February 12th or 13th, depending on how it falls. It can't be greater than 45 days. Otherwise, they will need to update the financial statements for the 2 years and the stub period. The financials do have to be updated in all stages of a filing date, the effective date, and the mailing date of the proxy statement. So it's key that those financials are continuously updated on the target side. Again, like I mentioned, the SPAC side has their filing reporting requirements, so that is always being done. Otherwise, there's something that is called when they're stale, and when they're stale, that means they're outdated. Therefore, you need to update them. The same thing with the pro forma financial statements, and I'll hand it over to Chris, but once you determine which historical financial statements in, you need to have the pro formas reflecting the historicals for the most recent reporting period. I'll turn it over to, oh, before I turn it over to Chris, again, this is key in this process is who's going to take ownership of the pro forma financials. These are complex reporting requirements, and the SPAC itself, has a handful of pro forma adjustments, which are fairly, simple and, common that you see. But it's on the target side where the adjustments can be complex and only the target team would know what adjustments need to be done. And this is where the financial reporting advisor is key in order to assist management in order to prepare these pro formas, because again, the auditors are not allowed to do this on either side for the company. So I'll turn it over to Chris to go a little bit more details on pro formas.
Yeah, I think it's just kind of going back on the coordination side. It's definitely one large timeline and making sure that everyone adheres to the different points in time of projecting out when the proxy vote could be or when we're going to file to make sure that different financial statements don't go stale, the age of those financial statements, how many years are being presented. And probably the other thing to touch on briefly really quick that kind of just came to mind was significant acquisitions from the target companies as well too, right? So these target companies are either going up and doing bolt-ons, or the management teams could be putting multiple kind of companies together beforehand. And that might trip up additional filing requirements for the target company, which could cause delays. But I think pro formas, which are kind of near and dear to our firm's heart at this particular moment in time, really is, I think, one of the bigger components there. So between pro formas, beneficial ownership, it's really just understanding the mechanics of the deal and how many shares are going to be getting issued and what type of consideration is going to be issued. And there's a lot of different people that are looking at that pro forma. It's both sets of auditors, both on the targets and the SPAC side. It's the legal teams and it's the investment banking teams that are looking at the deal, that are looking at the pro formas. But the pro formas usually have kind of two components, a balance sheet and a P&L component. The balance sheet assumes that the deal is done at the balance sheet date. So 12/31 in most instances. And then the P&L is assuming that it's the earliest date for the P&L. So it would be, if you're showing a year in your pro formas, it would be Jan 1 there. The nuance there is that you could have different adjustments on your balance sheet, and then your P&L, most locally related to kind of stock comp or different types of assumptions that would go in, of vesting requirements or anything along there that has a different time period to it. It would be about a year time period. To Natalie's point, there's always, I've never walked into a deal where everyone knew exactly what everyone was doing on kind of day one. It kind of gets kind of vetted out. And there's an education process to it as well too, with the various different teams that have to occur of what is the process, how quickly it moves and what that looks like.
Thank you both for that. For our last topic here today, I'd actually like to shift gears a bit and spend a few minutes talking about some of the recent events that have come into play, which are having a significant impact on SPACs. First topic I had, Barry, actually I'll direct it at you. You briefly touched on it earlier in our discussion. It pertains to the public statement that was released by the SEC earlier this month. It's specifically covering the inclusion of forward-looking statements within target financials. Could you spend a few minutes talking about that, the history and kind of where you see that going, or where the SEC is suggesting that goes?
Sure. And the SEC in their infinite wisdom has kind of decided to put a damper on the market. I'm not sure how else to put it. They've decided that there are certain aspects that they want to look at more closely, and there are certain things that, because once again, they think this is akin to an IPO, they want to make it closer to an IPO. Up until literally a month ago, When you did your business combination, you would look at the target. The target would prepare projections, as I said earlier, look at 2022, 23, 24, 25. And then you would take those projections and you'd go out to market with those, or you certainly would go to pipe investors with those. And the pipe investors were investing based on those projections. And you always put a line in that, these are projections that, they're subject to change, don't rely on these, but, wink, wink, here's what we think is going to happen. In an IPO, you would never do that. In a typical IPO, not that you're not allowed to do that, but you're not allowed to put language there that you can't rely on them. And because of that, you will never see an IPO that has projections in it, because people are concerned that they're going to get sued if you don't hit the projections. And if you don't hit the projections, you deserve to get sued for putting them in an IPO. Whereas with the SPAC, that was never an issue. So in the SPAC, up until a month or so ago, you could put projections in the document. You could use that for your pipe investors. You could use that in your proxy. You could use that in your tender offer. Whatever you do, you could use those projections, and it made people excited. The SEC has come back and said, because we think this is an IPO, and they haven't actually changed the rules. This is just a pronouncement at this point, but everyone's literally taking it as gospel, as they should, because they're telegraphing. They're saying, listen, if you put projections in, you don't hit those projections, you have a big problem. Okay, you will get sued, and I can assure you there's plaintiff lawyers that are out there looking at projections as we speak. So what's going to in effect end up happening is people are going to stop putting forward-looking projections in their proxies, in their presentations to the pipe investors. Presumably, they'll have some discussions, but it won't be as formal. And I also think what that's going to lead to is the valuation of some of the private targets. It's going to have to go down, because if you can't look at the numbers in 2023 or 2024, it certainly hurts early stage companies. As I'm sure, but there have been so many deals with electric vehicle companies that were really based on what's going to happen in the future. And that's no longer going to happen. So it's going to put a damper on the market. It's going to change the valuations going forward for these deals.
Thank you, Barry. Sticking with current events, moving forward a few weeks, as recent as last week, there was a development that's come out also from the SEC, which turns out to be a pretty big game changer for SPACs. And it surrounds the accounting treatment for certain warrants that are issued around the deal. I'd definitely like to have each of our panelists touch on this topic. And Barry, I'll stick with you here to get started. Would you mind shedding some light into the background of what the SEC is looking at here and ultimately taking issue with as it relates to the provisions and the corresponding treatment of the warrants?
Yeah, and this is an issue that's not a new issue. This issue came up in 2016, 2017, and the SEC looked at the issue very carefully and decided it was a lot to do about nothing. But sticking with my theme that the SEC is trying to slow down SPACs, there was a registration statement that was filed with the SEC, and the accounting firm, and it was not Natalie's firm, but the accounting firm basically put in a question or a comment saying, we understand that you're not treating these warrants as a liability, but you might want to think about that. So, and it's in effect was I'm not quite sure what made them do that, other than from what I understand, the person who put in the comment had formerly been with the SEC and believed the SEC came down with the wrong conclusion, in 2016, 2017. So, and Natalie and Chris can go into a lot better details than I can, but basically the SEC has changed their position on the treatment of warrants. And they're basing that change really on, at least preliminarily, on really two provisions that are in certain or most warrant agreements. In the history of the SPAC program, these two provisions have, from what I understand, people have done a lot of research, not me, but others, that these two provisions have been enacted once in 20 years. So it's not as if these provisions come up on a regular basis, but SEC has in effect hung their hat on two provisions, said, if you have any of these provisions, either of these provisions, then we're going to treat the warrants may have to be treated as a liability, which obviously changes your financial statements. It changes everything throughout the document. And until there's clarification, the SPAC IPO market, the SPAC business combination market is all basically on hold. And Natalie and Chris can go into the details, but it's a huge game changer at this point.
Yeah, I think we generally see two warrants that are issued. It's a private warrant and a public warrant. Not diving kind of too deep into the debt and equity guidance for GAAP, which is extremely complex and often gray and up for interpretation. To in my personal point of view, there's a fact pattern where a private warrant could be transferred effectively to someone that's not an affiliate of the entity, and that it changes form. And when you look at the indexation guidance, there could be a view that's taken there that the fact that something changing form from one person to another person wouldn't fit into what's called the fix for fix option, meaning that it fits nicely into a valuation model. Usually things that kind of fit into those are stock price volatility, risk-free rates, or things that are tied to the entity's stock. Something like the holder of an instrument is not something that fits nicely in there, and therefore kind of precludes equity classification. And I think in the instance where the SEC reviewed this, it was more around the private warrants. I think the second thing that was out there was the tender offer provision, and to Barry's point, our understanding and kind of what we've heard is there's a lot of steps that have to occur for this particular provision to go into play. And the language, I think that's in there, and the way that it was interpreted by the SEC was that in a tender offer scenario, the holders of the warrants could get all consideration for their underlying common stock before the other holders of the true equity common stock instruments. And just for, not to get kind of too much in accounting, that means that just the warrant holders would be in front of a waterfall or the cap table to the other common stock holders, which causes some which doesn't fit well into the equity classification guidance. I think what this does just primarily is kind of going through existing SPAC warrants and just making sure, hey, what's going on and what is the right treatment, and that's not something at this particular time that could be done globally. It's got to kind of be done for every single warrant instrument and by team and things like that.
Thank you both. Yeah, it sounds like there's companies are going to have to revisit their warrant agreements and determine if they're impacted, and if so, revisit any previously filed financials. This final question I have here before we wrap up, Natalie, would you mind providing some details as to what that process would look like in the event that companies find that their previously filed financials are incorrect under this new guidance, and what those communications should be that they'll have with their auditors if they move through it?
Sure. So the companies are going to need to evaluate that and work with their financial reporting advisor on determining if there was an error and if the warrants should be accounted for as liabilities. It involves getting a third-party valuation on these warrants, and then performing a SEB 99-108 analysis on the materiality of these items. Once that's determined, depending on the materiality, they will need to or not need to file an item 402 form AK indicating previously financials cannot be relied on. Again, it all depends on the materiality. When they do their assessment and work with individuals like Chris and your teams, they're going through the quantitative analysis, in addition going to the qualitative analysis. And once that's done, again, like I mentioned, they'll determine if there's a non-reliance or not. If they do conclude that there are errors and they are material to the financial statements, the SEC has put out the statement that they can file their amended financials in all periods in a comprehensive 10K. And they provided that guidance on April 12th in their bulletin, noting that that's how they can correct those items. In addition, they did say you need to go back and make sure you evaluate internal controls, disclosure controls, and other items. So this is a big undertaking. It's not something that's done overnight. As you can imagine, it's a significant amount of work for all team members, start with attorneys, advisors, company, and the auditors. but it is continuously evolving at this point.
Thank you, Natalie. And thank you to all of our panelists for the thoughtful commentary during our discussion today. To everyone who turned in this afternoon, I hope you found the dialogue around the SPAC and de-SPAC process to be informative. And should you be interested in any additional information on the topics we covered, feel free to reach out and connect directly with our panelists via LinkedIn. Thank you again. Appreciate you watching, and I hope you enjoy the rest of the Planet MicroCap virtual conference.